Sunday Overwatch, 5 layers, 1 verdict. The week ended at the highest possible point in 2 months. Friday's record close sits 1 day before Monday's open. And what you do at that open depends on whether you can read what's underneath the surface, not just what is on it. 5 analytical layers were built independently this weekend. Institutional positioning, macro, sentiment, volatility, sector dispersion. Each one starts from a different angle. Each one has different inputs. Each one was assembled without reference to the others. And every single one of them lands on the same verdict. Continuation works into Monday open. Probability is high. But the easy money is now priced. Let's walk through what each layer says, and then we will look at the friction signals each layer carries underneath, because the verdict is only half the story. Layer 1. Institutional positioning. The Commitment of Traders report shows asset managers net long 995,000 S&P 500 contracts. Hedge funds net short 403,000. That is the largest two-cohort divergence we have measured in 2026. Big money is positioned for continuation. Fast money is hedged for the opposite. Both can be right at different time horizons. But for Monday's open, the institutional conviction is on the long side, and that bid sits underneath the tape. The friction signal here. When two cohorts are this far apart, the unwind on either side is violent. Layer 2. Macro. PCE printed in line on Friday. The week ahead is light on top-tier data. ISM Services on Wednesday is the only print with the power to move the curve. That means Monday and Tuesday have an unobstructed window. The Federal Reserve speaker calendar is quiet through Wednesday. The fiscal headlines are quiet. The path is cleared. The friction signal here. A clear path means there is no obvious catalyst to break the dominant trend, but it also means there is no catalyst to confirm it. Drift is the highest probability outcome until ISM Wednesday. Layer 3. Sentiment. The fear and greed reading sits at 66.6. That is greed territory, but not extreme. Retail surveys are near neutral. The hedge fund positioning we just covered is near a 5-year extreme on the short side. So you have 3 sentiment layers disagreeing with each other. The crowd is greedy. The retail trader is undecided. The professional is hedged. That is the kind of disagreement that produces continuation, because no single side is positioned to dominate the unwind. The friction signal here. When sentiment readings diverge this much, the resolution comes from price action, not from sentiment itself. Watch what the tape does, not what the surveys say. Layer 4. Volatility. The VIX closed Friday at 16.99. That is down 11.6% on the week. We flagged that as the call of the week on Monday. It happened. The VIX 9-day reads even lower at 15.1. The term structure is steep, but here is the friction. VVIX, the volatility of volatility, sits at 95. That is not low. That is professionals continuing to pay for protection on the protection. The dealers are short volatility. The institutions are still hedged. The friction signal here. When realized volatility drops but VVIX holds, the next vol expansion is sharper, not gentler. A reclaim of VIX 17.5 would be the first signal that the regime is shifting. Layer 5. Sector dispersion. Friday was a record day for the index. Only one sector closed green. Technology, up 1.49%. The other 10 sectors closed red or flat. That is the definition of narrow leadership. The index is making highs because the largest names are dragging it there, not because the market is broadening. The friction signal here. When breadth narrows on a record day, the rotation is one missed earnings print away. Any tech name that disappoints can take the entire index with it because there is nothing underneath to catch the fall. So that is the composite read. 5 layers, each one independently bullish for continuation. Each one carrying the same friction underneath, which is that the easy gains have been compressed into the price already. What does this mean for Monday open? Standard position size on tested support. The institutional bid is real, the macro path is clear, and the volatility regime favors the long side until something breaks. If you have a setup at a level the framework has already identified, take it at standard size. The probability is high. Reduced position size on aggressive new entries. Anything chasing strength at extended levels carries asymmetric risk because the easy money is gone. The reward to risk has compressed. If you are buying breakouts on Monday, size them smaller. The payoff is not what it was 3 weeks ago. Full retreat on a VIX 17.5 reclaim. That is the line. If volatility takes back 17.5, the regime has shifted. The dealer book flips negative, and the unwind we have been hedged against starts to play out. Don't try to be brave on that print. Cover and reassess. That is the Sunday Overwatch synthesis. 5 independent layers, 1 shared verdict, 1 shared friction. Continuation is the high probability path into Monday open. The easy money is priced. Trade what is in front of you, not what was in front of you 3 weeks ago. Full composite read on the website. The instrument-by-instrument breakdown is in the daily reads. The Monday brief drops at 6 p.m. London time tonight. This is education, not financial advice. Always manage your risk. Titan Protect, Sunday Composite, Monday Open Framework.